When Julio and Janine Munoz decided to get married, they wanted to make sure they had a home.
We could rent and wait a little while and then buy, or we could buy right away. And we decided we wanted to have our own house.
Right, and we had to spend money on the wedding and buy all the beautiful flowers.
All those important things.
So we needed the money.
My wife had been looking at buying a home, so she'd done some research, and she, believed that putting 20% down payment was really the best way to go. But putting down 20% in this market wasn't going to give us the home that we really wanted to have.
But thanks to private mortgage insurance, also known as PrivateMI, Julio and Janine were able to cut their down payment by 3/4.
PrivateMI allowed us to have a better home by putting 5% down and then taking that money that we saved and paying for our wedding and other expenses that we had at the time.
During the past several years, lenders have increasingly looked at the issue of risk and determined that it's possible for people to acquire real estate with less and less down.
Industry analyst Peter Miller says PrivateMI has opened wider the door to home ownership.
It used to be that people really wanted you to buy a house with 20% down. And then they said, well, all right, 10% down. And then 5% down. And now it's possible to buy a home with less than 5% down, and in some cases with nothing down. And so for first-time buyers who are on the cusp of affordability, private mortgage insurance is a tool which allows them to acquire real estate today rather than at some distant point in the future.
This is the first thing you've got to fill this out so that we can pull the credit report.
While most down payments below 20% require PrivateMI, some buyers opt to avoid paying mortgage insurance premiums by taking on a second loan in piggyback programs such as one known as 80-10-10.
Everyone is coming up with a different loan product, and quite frankly, the average home buyer doesn't know the good, the bad, and the ugly of any of these programs.
Housing advocate Marcia Griffin founded the nonprofit organization Home Free USA to help prospective home buyers with just these kinds of issues. She says information is the key.
The reality is, particularly with the no MI, what a person really needs to look at is what are the other costs that they have to pay that compensate for that no MI.
The catch is that second loan can be very expensive. It has typically a higher interest rate than the first mortgage, and the result of that is you can have steep monthly payments. Which one is better? Which one is cheaper? Think about it this way. After a while, once you pay down your original loan balance, private mortgage insurance can be canceled.
PrivateMI payments usually drop off after the owner has achieved 20% equity, but there's only one way to escape the higher interest rate of a second loan.
The alternative is you could say, well, okay, I'm going to get rid of the first loan and I'm going to get rid of the second loan and refinance the whole house. Well, then you've got to pay to refinance the entire amount that's outstanding, and that's a big amount, and the cost to refinance a whole house can be expensive.
And with interest rates at historic lows, future refinancing promises higher rates, not lower. Here are some items to keep in mind when considering a second loan as you purchase a home. Will the interest rate on the second loan be higher? Will the term of the second loan be shorter? And if either of these are true, what will that add to your monthly payments? Is the interest rate on your second loan variable? And if so, which direction do you think rates will go? How will your ability to get a home equity line be affected if you have 2 home loans instead of 1? You may find it harder. How difficult will it be to refinance 2 loans instead of just 1 if conditions warrant? One thing is sure, the low fixed rates afforded by private mortgage insurance have fueled an engine that's powering the economy even as other sectors fluctuate.
It becomes very attractive for people to obtain real estate when interest rates are low. And so when rates are low, when loan qualification terms are attractive, and when real estate can be bought with little down, for example, through the use of private mortgage insurance, this turns out to be good for everybody throughout the economy.
For many Americans, particularly for many minorities. The problem of housing affordability and coming up with any down payment is pretty significant. So having the MI and being able to pay the 3% or 5%, and you know, this is really what homeowners and home buyers need, they desire, and it's really the only way that housing is really going to expand in this country.
As for Julio and Janine, they say PrivateMI sure beat the heck out of waiting till they had saved up 20%.
I think that saving up for a 20% down payment would have taken us at least 5 years. By then, the house that we wanted would probably not have been on the market.
For more information on low down payment home loans and private mortgage insurance, visit www.privatemi.com.